Friday, the 6th of December 2024, price action review. Going to cover the NQ today and specifically look into the Friday continuation of this trending week. So this is actually going to be a second recording, or rather fourth, but the second time I tried to record it, because the last time I did it, which was on Friday itself at 2 a.m. At night, I recently just found out that I was recording my screen of the wrong screen, which was a black screen, the entire time. So I've been talking in that video for almost 40 minutes, but unfortunately didn't record my screen. So I'm trying to make this one a bit more concise and straight to the point. I in general want to do that, but now even more so. The daily chart, can see that price dropped down into this fair value gap today. It did this overnight in Asia. For me that is overnight, but it was just prior to Asia that price dropped down into it. Then at NFP it expanded, after NFP it expanded higher to create new all-time highs, taking out that previous day high and towards that -2 standard deviation using the breaker swing point here as to derive at projections as ICT taught in the 2023 mentorship. Initially on Thursday I was looking for the market to perhaps drop down into this fair value gap at NFP release, but it did it already in Asia. But nonetheless, NFP was used to manipulate, which then set up the stage for a run higher, which we will look into on the 50-minute chart specifically. But it just continued to trade higher on Friday. Initially was a bit conflicted here because of the Thursday candle, because usually Thursday creates the high of week on bullish weeks, but exception is of course when we have very bullish trending weeks or bearish trending weeks, lower in case of like a Thursday low of week. But in case of a bullish week and it's very trending, then often Friday will just continue to expand higher, then Thursday not create the high of the week, and then close very close near its high, which is what was the case this week, which will be more refined seen on the 1 hour chart. So for our chart, you can see the market drop down into this daily fair value gap. Notice how the bodies are staying above that daily fair value gap. It also dropped down into this converging PD array on the 4 hour in the form of this consequent encroachment of the inverse premium wick. That's a whole long sentence, but it's basically just, you could also say it's a discount wick, but I like to really stick to the terms, as this was initially a premium wick. Once the market expand above it, this is now going to act as an inversion, so inverse premium wick is how I then notated this. The market then dropped down as outlined. Notice the initial respect here of that C level, then the market dipped a little bit lower, eventually expanding higher as it again reaches down into this wick rejection block, and then expand higher to tag out the previous day high and create new all-time highs. Right, 1 hour chart. Can really see the details here being shown. Notice how we have this bullish order block on the 1 hour, which is nested inside of this daily fair value gap, and then really look at how the bodies are all staying above that bullish order block and only the wicks trading down into it, and only one wick reaching down into and just below mean threshold, which occurred indeed just prior to Asia. So seeing the signatures, you never get bored of it, seeing these precision elements, even though you might have tape read it so many times and backtested it so many times, etc. But just yeah, there's something about it, something magical, which is kind of strange. The market then dropped down at NFP release, divergence taking place, a very large, obvious divergence between SMT, between ES and NQ, where NQ fails to take out this low and ES does take out that low. SMT, underlying accumulation, and because NQ failed to take out its low, this indicates underlying strength in NQ. So the relative strength leader for the day in particular was NQ, because of it failing to take out its lower low, its low. So what can we do with that information now? We can expect the more extrapolated move to the upside to be in the Nasdaq and apt to trade that market instead of ES, because you will have a much easier time. It will have a much easier time to reach for buy-side liquidity draws and beyond in this case than ES, because it's the relative strength leader in Q. The market dropped down into this mitigation block, and then the market expands higher, then goes back down in this fair value gap as institutional order for entry drill, converging with this old high, not instant like directly, but with old high that converges with a busy. Then you usually see a institutional order for entry drill. Then the market expands higher, closes very close near its high, which was what we were looking for after we saw this formation here. And then in the very bullish order flow and trending week, then often the market closes at near its high on Friday. So that's what we fold. Yeah, one thing, this looks on the surface like an indecisive candle, as said, like a small body, a long wick to the upside, a long wick to the downside, but it really isn't indecisive as you might think. Like usually you might think indecisive candle, it doesn't know where to go, but often that's not even the case, because we already have the narrative in mind that price is going higher. The market drops down into this order block at NFP, so that's the Judas swing. It moves lower, take a sell side into a discount array, SMT. So although it looks indecisive, it's really just bullish. So that's what also happened right after with the large expansion. So it's not as indecisive as perhaps a retail trader would think, because you have all the narrative and backdrop behind the idea, which indicates that it's really just waiting for it to expand higher at the 9:30 opening. So little notation on the 1 hour chart. As I stated, the high of the week on bullish weeks forms 70% of the time on Thursday, and then specifically Thursday New York session. But this wasn't the case this week. Why? You might ask. The reason for this is that it is a trending week in a very bullish order flow, and may I say extremely bullish order flow, as we are creating new all-time highs this week. So when that's the case, and we have this scenario in play, the market is likely going to continue to expand higher on Friday. It goes very close near its high, and this also means as a consequence that we are not going to see a TGIF scenario unfold where the market retraces back down into the weekly range 20 to 30%. We are not going to see that at all. And I initially actually was wrong in my analysis. Yeah, I was wrong, but specifically I was overanalyzing it. Since I'm just going to use this channel as like a point of reflection to later look back on, I just might as well talk about what I experienced this week, since I think actually the only person who's going to watch this back is me, since I just used under code name, just don't have social media, etc. So it's just really like a personal measurement of growth, this channel, to if I progressed in my understanding of price action. And the ideal scenario would actually be for me to look back in 2 years from now and then look at this old video and just see really cringe almost of the things I say, because that shows really I've grown an understanding and perhaps say something now that's actually wrong, and then realize then that it is wrong, because that shows that I have found a better way of doing things. But back to the topic. I initially was just wrong here. I was not looking for a Thursday high of the week, but I wasn't confident enough to really target that Thursday high of the week because of that 70% of the time scenario. I had this in mind that it was likely going to expand higher, but for some reason I complicated it for myself, and it's very important trading to keep things very simple. You have to know things in depth and really have an understanding of it before you can simplify it. But once you have that, you really want to simplify it to core principles and don't have a kitchen and sink approach, etc. But once I saw that the market really showed willingness to expand higher after the SMT divergence took place at the bullish order block on the 1 hour, and yeah, I got some. It's like sometimes that old videos of ICT or Twitter Spaces go through my mind when I watch a price action, when I see certain things, and I remember when ICT talked about it, and this was the case here too when the divergence took place and I saw the manipulation take place at NFP. I really thought about the exact scenario I outlined here of it being a trending week that will close near the high on Friday. Like just continue to expand higher into the close. So I got them back in sync again, and although it didn't really offer me any opportunities anymore according to my model, I still taper it the rest of the session. I don't trade PM session on Friday, but I did study it, so that was good. The reason why I generally don't trade PM session on Friday is it's usually more consolidating out of my backtesting and overall experience, and it's like the last session of the week, so I don't really want to go with a loss into the weekend. It's something easy to avoid, because you don't really have the time anyway to make it back, and not that you have to make it back, but you don't have even the opportunity to do so when you're really trading that PM session, which tends to be consolidating, which was the case today too. But yeah, I want to say that this is how it's done to myself. Trial and error is the greatest driver for growth, and it's really important to fail quickly, really. So 15-minute chart. I talked a lot about this yesterday night when my recording failed, but I will reference the main points here. Otherwise, I'm just repeating myself, and the whole purpose of this channel is to teach myself, and if I already went into it, that's like repetition. That's really not productive. But the market showed here this clear SMT at the 1 hour as outlined on the 1 hour chart, this order block. NFP just really dropped down, take out sell side, a clear manipulation against a decline against the underlying narrative of higher prices against the order flow. Did you just swing for the daily range and the New York session? The market then expanded higher above this mitigation block on 1 hour, which is now a breaker on the 50-minute chart. Low, high, lower, low, breaker. Extend out in time, you can see that the market has been consolidating right shortly after the news release of NFP, between like 8:45 up into 9:30. It was really just consolidating here, which was actually time distortion. It was really just the market passing time in a wait for the 9:30 opening, where it will really show its hand in that sense. So it happens at the bullish order block, but notice very specifically that price purposefully kept this fair value gap open. Here it was already created at the 8:45 candle, and then at the 9 a.m. candle, the 9:50 candle, it refrains from trading down into it and just engineering sell side here on the lower time frames. And then at 9:30 the market drops down into that 15-minute fair value gap, the base of institutional order flow entry drill. Why? BPR. See? SB, busy, sells a delivery, buys a delivery, comes back down, bends price range, leaves it. Then we saw a rapid expansion higher at 930 after that initial small Judah swing. Then that expansion higher towards the previous day high and to and through the previous day high, because we still have time of day phenomenon in place, so we don't expect when it's so bullish like this the market to just poke its head above the previous day high and reject, snap back into the range. No, we expect the market to really expand through that previous day high, and because it's an old high, banks like to trade off daily charts, so they have liquidity resting above all daily highs, daily lows, and it's going to clear all that open float above that previous day high, and that's what it does with this large expansion candle. I noted standard deviations on the basis of this manipulation swing, which was the low up to the high prior to the low prior to the retracement lower. I had a better way of formulating it, but it's really just a Fulcrum point that I used here for targeting. You can see that the body's respected -4 standard deviation very nicely. It's not a breaker standard deviation, it's a manipulation standard deviation. It's not a breaker standard deviation, it's actually just a manipulation standard deviation where you used the low up to the high. So it's like, damn, I'm yapping here. I have to edit some things here. So I use this standard deviation to provide projections to the upside. You can see that -4 of the standard deviation is perfectly overlapping with the bodies. Notice how they are respecting it. They're stopping right dead in its tracks at the -4 standard deviation, which is kind of interesting to see. It's not a breaker standard deviation. It's just the Fulcrum point I used here. Typical swing trading ideas. Swing trading ideas, that was the name. Let's see what I have more to say about this. Yeah, the market drops back down into this fair value gap on the 50-minute chart. This darker shaded area is a 5-minute fair value gap. Notice how the market is respecting CE of that fair value gap, then expands higher, bullish order block on the 50-minute chart. Market drops down into that bullish order block and into this discount wick CE, expands higher, takes out AM buy side, and then just comes back down into that same bullish order block. Why do I continuously refer to this bullish order block? Well, it's even clearer to see on the 5-minute, but yeah, I will just go into it on the 5-minute. The market then expands higher and just closes near its high here, eventually dropping down and closing near this high, failing to take out this high in lunch. That's going to be it for the 50-minute chart. This is a breakaway gap. Something I noted in my I've been watching some of the core content lectures, and one of the things I noticed was that I watched the video back in month 6 where ICT talked about impulse swing, retracement, and then expansion swing, and I observed actually that often the first value gap that forms after the first value gap that forms in the expansion swing tends to stay open and act as a breakaway gap, and we actually see that phenomenon take place here as we have an impulse swing, retracement, expansion swing. First value gap stays open, market comes back down and then into the upper value gap, leaving the lower value gap open. And this then indicates of a low resistance liquidity run, because if it's high resistance then it may as well go back here. But in case of a low resistance liquidity run, I think it tends to stay open. I backtested quite a lot, but I should probably do it even more, because breakaway gaps is one of the things I like to have a little bit more insights about. I want to keep my trading very simple, but I think a breakaway gap is a pretty key component, or at least it's a very nice signature to have, because it not only tells you, it really tells you when to stay, when a gap should stay open, and when you should then really frame your trading around this. Because if you be waiting for the market to trade lower into this gap, then you would have missed the move. Not that there isn't much of a move here, but there was a market maker buy model on the 1 minute here. So if you would be waiting for this, then you would have missed it. So yeah. Our 5-minute chart. We can see that the market really took a sell side here, dropping down into that 50-minute upper value gap on the base of EOFET. The market then expands higher with immediate rebalance here, boom, take off. Like, that's like such a nice signature to see the immediate rebalance when you're already expecting the market to move higher, when we have a clear drawn liquidity above. When you then see immediate rebalance, then you just know it's gonna take off, and that's what it did. It really expanded higher rapidly. If you rebalance price range, but the market moves higher, and then reaching for that previous day high and beyond. Something you can then note was this IPDA dealing range, where we use the opening price of this change in the state of delivery up to the high prior to the retracement, and we can use that to define a dealing range. Because if we would have used the standard dealing range low, dealing range high, price would have never come back down into equilibrium, nor discounted, of course. But if we used IPDA dealing range, the base of that change in the state delivery candle, then we can see the market drop down into discount and then expand higher. Notice again the body staying above the 50-minute fair value gap on the 5-minute chart, a nice signature. Then see some consolidation. So it's really just again time distortion, as price was waiting for the 1250 to 110 macro. You can see the market spending time in and around this bullish order block. Why do I refer to this bullish order block? I initially wanted to say something about it on the 50 minutes, but I will do it on the 5. Because this is the most, first of all, because it took a sell side here. So that's like the main thing. These down close candles didn't take any significant level of sell side out. It's also the most obvious one, down close candles. And perhaps most importantly then, after the sell side, was that all of this price action is encapsulated inside of this down close candle. So really just spending time inside of this larger down close candle, and this, I wouldn't refer to this as individual down close candles. I would just refer back to the core, which is this down close candles here as a bullish order block. And you can see that sensitivity, especially here, but also here, really comes of this level and not anything else. Market expands higher, takes out AM buy side as offset distribution. Right, initially it forms a high here, traders are going to see that and look to go short. Then they ran it up one more time for offset distribution to offset more longs to waiting sellers at a higher price. And then the market really just consolidated going into close. Yet some 1 minute market maker buy model here again. It was a good study, but outside of that, nothing really that insightful, as you wouldn't expect the market to do in the last session of the week. You would just anticipate consolidation as it's already met its higher time frame draw. Finally, another thing I wanted to note here was how we could anticipate the market to expand higher for offset distribution, and not just for the sake of these low resistance liquidity driven signature highs, where this is way too smooth, they're not going to leave that intact. But also because the market has been in a consolidation here, and the market cannot reverse from a consolidation. Month 1 core content. Really, that was one of those lectures where you would just completely overlook it the first time or the second time you watch it, and only after you have gained experience you begin to really understand what IST meant with all the things he said there. But you can see indeed that the only possible cycle after consolidation is expansion and not reversal. So it's going to expand. Then we have 3 options. First option is consolidation, expansion, retracement, expansion, consolidation, expansion higher, and then reversal, or consolidation, expansion lower, reversal, expansion higher. And that's what we saw here. We saw consolidation, then expansion lower. It cannot reverse from a consolidation, so this is always expected to be false. And that's what we see, reversal and then expansion here, then some consolidation again, and then expansion higher. And eventually we do see the reversal, but then snapping back into a consolidation after expansion lower. So that was very cool to see unfold live. So in closing, I have this 1 minute setup of a model that I actually missed to engage in. I wasn't that focused, and I really notated that, since that's really something I have to improve then. Because this here is my model. It's framed on a 50-minute internal range to external range structure, which we see here. Market dropping down into a discount for value gap, and the buy side is this external range draw. So internal to external, very simple. And that structure will set up the stage for a 1 minute market maker buy model. And in this case, it was a market maker buy model on 1 minute as part of a larger 50-minute market maker buy model. So a larger, higher time frame buy side of the curve. So that's really like the most ideal setup you can have. You can see here the signature of that first buy side get taken, then sell side, and then SMT at lows, and then at low resistant liquidity run higher towards the buy side draw. The clear market mechanics as outlined in the 2022 mentorship, and also from some of the guys that on YouTube that simplify IST concepts, which are good, but you do have to understand, you have to at least some reasonable to good understanding of the intricate details, because otherwise it's just going to be feel like you missed something. But when you do have something, then, yeah, of course you want to simplify it as much as possible, but you can't simplify something that you don't understand, that you don't have an understanding of, right? Then it's just going to be shallow. But you can see that the market here drops down into the breaker. That this was my entry, and I should have taken it this, but I didn't. It was right after the 9:30 opening, and I wasn't focused enough. So the next time I absolutely want to take a setup like this, and don't take it due to a little distraction that caught my eye, and really be dialed in. The market then moved up higher. It could still dip down into this first percent for value cap, and I was waiting for the market to do that, but it didn't give it to me. And then it just spooled higher towards the buy side liquidity draw. The option was still to drop down to a 30-second or 50-second, but I was actually trading off a CFD account that day, so I didn't have the opportunity to drop down. So I just saw it take off. You had this retracement down at this those candles, but yeah, then I'm just really chasing price in my opinion, although we have a breaker. But yeah, I should have really just entered here and it would all be good. But it's something to note and really learn from, to be able to capitalize on it next time. But the opening range volatility was used to really expand price higher towards the buy side liquidity draw. And one thing on the 50-minute or 5 minutes is also fine. I noticed at what time the whole expansion takes place, between 9:30 and 10 a.m. the opening range. So it really just did all its movement inside that opening range, if the manipulation already done prior to the opening range. So it was really just accumulation, manipulation, and then distribution right out of the gates from the 9:30 opening all the way going into the 10 a.m. hour, and then it was really just consolidation. So of course you could find setup on the 1 minute, but the most probable pricing was really just this whole structure here. But it was interesting to see that really just did all its business between 9:30 and 10 a.m. That was really something I noted in my post-market analysis. So this is going to be it.